Over this past weekend, the nation had some tragic events take place in Pennsylvania. We're going to talk a little bit about that, what the implications might be for the market today on open interest. Hello everybody, I'm Mike Coe. Welcome to Open Mic. As you can see, I'm in yet another location, so Open Mic continues to be sort of on the open road, although I am back in California. As I was returning to California, obviously I was shocked and surprised by the same news as many of you undoubtedly were. The attempted assassination of Donald J. Trump over the weekend at a campaign rally in Pennsylvania, and of course the tragic death and serious injury of 3 other attendees of that rally. Now, I've seen quite a lot said about essentially where that leaves us as a country and whether or not this puts us in a precarious spot. I would say a couple of things about that. The first is that, as I've said on earlier live streams, and this just has to do with the possibility that Trump is reelected to a second term as he runs again. And just to remember what happened in 2016 when he won that election versus Hillary Clinton. And I think the consensus view leading into that is that it was unexpected and potentially volatile and disruptive. The futures sold off fairly sharply as the election results were coming in, but they very quickly recovered. And then the subsequent weeks after that election, the market rallied very, very sharply. And I think the reason for that was that the markets viewed Trump to be more market friendly, shall we say. And I would point out that, we're also hearing from Mary Daly, who is the president of the San Francisco Fed. She was asked to opine after this weekend's events about whether or not she had concerns, economic concerns, about a second Trump presidency. And the answer to that was no. Incidentally, it turns out that she was meeting in Park City. I happened to be in Park City over the weekend, although I didn't realize that they were all there. Had I been, maybe I would have stayed and tried to see what was going on. That would have been very interesting. And I think the market is validating these views. We have the S&P at all-time highs once again. I think that the view is that a second Trump presidency, which is looking increasingly likely, whatever side of the aisle you happen to be aligned with, or if you aren't aligned with either. I'm a registered independent, always have been, a little bit more of a policy wonk myself. But I think the safe assumption is at this point that the favored candidate at this point is likely going to be Trump in November. And the second thing, of course, and this deserves to be discussed, in addition to us spending a little bit of time trying to remember the victims of the horrific attack that took place, is that a lot of fiery rhetoric and whatnot around the edges about various conspiracy theories and whatnot. Both Trump and Biden called for unity after this, and for everybody having a political conversation right now to tone down the rhetoric. Let's hope that they do. Not wholly optimistic about that, but let's hope that they do. If they do, though, and if we imagine that the market's going to absorb a second Trump presidency much the way it did the first, then I think that the general thesis that I've had for most of this year, that this year feels a lot like 1999 to me, although with valuations somewhat more reasonable than they were then, that the rally that we've been seeing could, shockingly continue. And I mention that because one of the immediate bits of feedback I was getting after this weekend's events, or during this weekend's events, I should say, was how do I hedge? Should I take everything off the table? And my answer to that is no, I don't think you should. I will also allow, though, that options premiums are not exorbitant. And so what I would like to offer as an alternative to committing fresh capital to equities would be to use a stock substitution strategy, which would just be to purchase longer dated call options. And to do that, one would need to presumably look at least out to the election and possibly out to the next inauguration, which would be taking place in January of 2025. So I can do a screen share here and just offer a potential example of a strategy that one could use. I'm going to use SPY as an example. I think, if you have a specific equity that you're interested in, this may be an appropriate strategy. Bear in mind that for many single stocks, the volatility may not be quite as attractive as it is here. So what I would suggest then is, one could just go out. I'm going to take a look here, and I'm going to just rely on the person in my ear to tell me whether or not you're able to see my screen right now. I hope that you are. I'm going to just go out to January. Now, a quick point. You're going to notice, I've often said that I like to use, when I'm using puts, I'll often look for 30 delta puts, at least 30 days out as a hedge. When I am purchasing upside call options as an equity proxy, I think it's okay to use a higher delta option than that. It's not necessarily a huge amount of convexity that you're seeking. You're just looking to get long delta effectively with lower downside risk. And I think I was looking at the 575 calls for January 2025 in SPY when I was looking at this. As we can see right here, those options cost a little over 22 bucks, almost 23 bucks. Not a cheap option in strict dollar terms, but the important thing is to think about the price of these options relative to the underlying. And so 565 is, give or take the round number we're going to use, the price of SPY at the moment. And so you are looking at something that is, well less than 5% of the current price of SPY in this case. Not a huge fan of using longer dated vertical debit spreads in this context. And the reason for that is that the delta of both options is going to be relatively high. I mean, you'd have to go quite far out for that upper strike. And the value of that spread isn't going to reach, even if the market took off, it's not going to reach the complete potential value of that spread right after the election if you went out as far as January. So, generally speaking, if you're going to try to make a directional bet of this type, I would usually favor just using a single leg, as is the case here. Also because we're sort of experimenting with what I'm going to call a travel light setup, which is just a laptop, a camera, an encoding device, and things like that. I'm going to try to answer several questions and work with you here and share some stuff. You're probably going to see we have a dog that's here, and perhaps she is going to go across. She has interrupted previous live streams in the past. She was also on the East Coast with us, by the way. Okay, so with that, I'm just going to bounce from this and go directly to some of your questions and comments. Red State Ron says, do a session old style, pick a stock, recommend the option setup, explain the logic like on options action. So you are not the only one to ask that question and encourage that type of setup. It's not a lock, but there is a chance that some or all of us might be participating in basically that old style setup. So we do it sometimes on CNBC. It's kind of a throwback. You've probably seen it. But I've been talking to some of my former colleagues from CNBC about doing something like that, and we definitely hope to. And had I actually seen your comment, I probably would have tried to frame one up. But I'll tell you what, I'll try to do one like that for tomorrow's live stream, because we're going to do one tomorrow. Okay. Wesley Yee asks, I'm long Apple in a taxable account with large gains. Good for you. I'm short the July 26th weekly 125 calls. Ran through and need to cover. Should roll out past earnings, question mark, strike, and date. Okay. Excellent question. So first of all, I just want to make this quick point. I've said it many times. Let's just take a look at when their earnings are taking place, how much the stock has historically moved, how much the options are implying that the stock is going to move now, before we make a determination about whether or not you would or would not sell a covered call against it going into that event. My inclination, if I didn't have access to some of the data, my immediate response would be, no, don't do it. As I've previously discussed on many occasions, there are 4 primary instances each year when a publicly traded stock is going to have information that's going to be new to most investors and is most likely to propel it in one direction or the other more sharply than you would normally experience. And that's going to be earnings. Of course, there are others. There is the worldwide developers conference for Apple. There's the new iPhone announcements that they have each year. So there are other catalysts. But in general, for most single stocks that you're invested in, earnings are it. Retail sales are going to, for those kinds of names, you're going to have a slightly different situation. And what you'll notice, if you can see my screen, I'm not sure if you can or not, is that earnings, which are going to be taking place on August 1st, right now, the implied move is about 3.5%. That is lower than the 4.2% that the stock has averaged over the last 10 plus years. And actually, if we just look at the last 8 quarters, which I think is probably an appropriate sort of look back period. I mean, I'm not sure that it's relevant to incorporate things like earnings during the pandemic or earnings from 9 years ago. Those types of things, it's like many other things. The most recent events are probably the ones we should be looking at most closely when we're trying to establish how much this thing could move around. But the stock moved up 6% last time they reported back on May 2nd of this year. And if we go back 4 quarters ago to August 3rd of 2023, the stock fell almost 5% on that day. And then we can see out of the prior 3 quarters, 2 were more than a 3.5% move. So what does that tell us? Does that mean it's a terrible idea to sell upside calls? That doesn't necessarily mean it's a terrible idea, but it also means it's not a fantastically good one either. At best, we could suggest that these are fair value. And if you are long stock and you are selling call options against it, synthetically you're short puts. So the question is, would you be short puts going into earnings in Apple? Well, probably not for that premium. Now, for those of you who are looking at this question and saying, well, wait a minute, he has a long-term holding in Apple and he's not going to want to incur a tax implication. Well, that's fair. You're not going to sell your stock, so you're going to have some long exposure no matter what. But I would say that I would rather that you short-term roll your options up or just cover them and then just look to initiate a covered call position after the event takes place. The amount of money that you would be collecting, and why don't we just quickly see what that would be. So I'm just going to pull up OptionPlay here very quickly, and just because I think that's an easier way to do it. And see how much you might hope to receive. It's going to be more than it would be for the week prior, to be sure, because there is that event. but how much? So let's just take a quick peek here. I'm going to just put in a short call option. And here's the next question. You know, would you rather be long a call option going into that event or a short one? And I think long is very likely going to be the answer. So stock is 235. You'd probably want to give yourself at least 2.5–3% to the upside. So that's going to be, you know, we'll call it $5. So we'll take it from 235 to, you know, maybe 240, like that. So how much you're going to collect? Mid-market price on that option is about $4. So that's less than 2% of the current stock price. Not terrible. Remember, I was picking whatever 2.5-ish% out of the money. So your max upside is going to be 5%. But, you know, to me, I think if you skipped selling calls into those 4 events, in most stocks, you're going to be better off. And again, there have been a lot of people who've done some work on this, whether or not options are systematically overpriced or underpriced, options on stocks going into events. And my friends at ORATS, at least according to the most recent study that I'd seen them perform based on the data that they had, this isn't work that I've done myself, it's just somebody else's work that I've relied on. I trust the people that did it. Suggests that it's not that great. And we see that based on the implied move. 3.5% versus a 4.2% implied. You know, just let it go. Ride the stock through earnings, and also bear in mind that if the stock runs up, you know, you always do have that risk that somebody who owns it thinks, oh, I need to, you know, do something, and even though it's not optimal for them to, they elect to assign you, exercise their option. So hope that helps. Steve Garcia says, given the new market dynamics, how do you feel about the following EOY trades, end of year trades? I assume OIH, which is the oil, one of the oil ETFs, and the Russell 2000, 350 calls, and January 2025, 230 calls. So yeah, I like both. I mean, look, I was just talking about a stock replacement strategy using SPY. You're kind of beating me to the punch here, but yeah, I think those are fine choices. The Russell 2000 in particular, you know, it's interesting. I've discussed this before. The challenge for the Russell is that their capital costs are higher, and they're likely to get higher still. There's just going to be a lot of supply of longer dated treasuries that could push up the 10-year, I think, a little bit, and that could bump up their borrowing costs, and they're just more dependent on it. So little bit of a tricky thing for the Russell 2000. I kind of like the large cap names because I just feel like that's, you know, you're always going to have the winners by definition in that group. Okay, so FinWest. Good morning, Mike. Looking for any observations regarding earnings this week? The pace of your stream is perfect. No need to pause. That's what the archive is for. Lots of info to cover in an hour. Yeah, well, I appreciate that. So, you know, it's interesting. I've normally over the weekend, first of all, I was traveling, so that, you know, limited how much work I was doing on this topic the way I normally would over the weekend with respect to upcoming events. But then, of course, the assassination attempt caught my attention just as much as it did all of yours, I'm sure. And so I was really trying to just contemplate the implications for that more broadly. That said, let's just take a quick peek at what is on the calendar. So actually, this was let's take a look here. Let's just take a look at earnings for this week. And I'm going to ignore anything that is taking place today because that's not going to be all that helpful. And let's just go out to tomorrow. So yeah, I mean, we obviously have a few more bank earnings on the horizon. Kinder Morgan, you know, obviously I kind of like that midstream business, always have. Domino's Pizza, let's take a look at Domino's. And one of the things I like about Domino's, I have to say, is that my feeling about them is that potentially less impacted in some ways by inflation. So there were other implications that they have faced and do face. A friend of mine who is an analyst that covers this space, was talking about inflation in cheese prices in particular, and that had some important implications. But the thing is that relative to, say, casual dining and some other businesses, they are a little bit lighter on the labor side, which is certainly a positive. And it looks like options are reasonably priced, implying about a 5% move, averaged about 5.8%. We can just take a quick peek at the company's valuation here relative to its own history. This is going to be a challenge we're going to see in many names. You're not going to have the market close to all-time highs and not have stocks trading at higher valuations as well. And sure enough, that's what we're seeing here. So it seems that my preference for things like Domino's Pizza is not unique, because the average turn for the group, and I don't think of these all as comps, by the way. I'm not even sure why Bloomberg defaults to this. Yum China and McDonald's and Starbucks are not necessarily the closest comps for Domino's Pizza. But I think it's just interesting for us to sort of keep an eye on those things. Some of those, and by the way, this is I apologize for this sidebar very quickly, but it's an important observation that I don't think gets discussed very much. So in the context of increases in minimum wage, which we hear all the time, so the minimum wage where I live was bumped up to $20 an hour, $25 an hour for people who work in healthcare, everybody from the janitors on up. $20 an hour, so we're looking at close to $40,000 a year is the starting wage for an employee at McDonald's. The interesting thing is that in this area, if almost every one of these places has a help wanted sign in the window, and most of them are saying starting wages at $22 and change. So it's already higher than the minimum wage. So we're really looking in the mid 40s is the starting point. But what a lot of people don't seem to remember about these businesses, and I think this is really important, is that when you see an increase in minimum wage and you're thinking about its implications for McDonald's, the implications are not felt negatively by McDonald's Corporation, the franchisor. It is the franchisee who feels that. It's the small business owner who owns the McDonald's franchise that's operating locally that has to pay those higher wages. The way McDonald's actually gets paid is as a percentage of sales. It's a strict royalty off the top. So they're in a weird way where people say, oh, we're going out to get these really big franchise restaurant businesses. Increases in wages can potentially benefit corporate to the detriment of the franchisee. Why is that? Let's just imagine you operate a McDonald's franchise, you're doing $3 million a year in gross revenues. All of a sudden your wages increase by, we'll call it 20%. That's an exaggeration, but we'll call it 20%. They decide that the price of a Big Mac, $8.50 already, we can't increase it 20%. Because if we increase it 20% from, say, $8.50, it's going to push it over 10, it goes to double digits, and somebody says, I'm not going to pay double digits for a Big Mac. Okay, so the franchisee, makes a determination on the pricing such that they get it so it's just under $10. What they see is margin compression at the franchisee level. What happens, though, just work through that and imagine, okay, what happens to McDonald's corporate? Well, McDonald's corporate doesn't get paid off the net. They get paid off the gross. So their royalty actually goes up, but their labor costs are unrelated because most of McDonald's corporate isn't dealing with the minimum wage that the franchisees are. So just an important observation. So this gets back to my Domino's Pizza thing, which is that relative to sales, they have lower labor costs. You know, if you go to the, and I'm sure all of you are familiar with this, you go to the Domino's storefront, the pizzas just go on a conveyor belt in one side, out the other. You have the delivery aspect, of course, but they have incentives for local pickup, and you have fewer people just pushing more food out the door. And we can actually see that in the valuation here. So we're up to a $17 billion market cap. This thing is trading 29 times forward earnings, which is higher than I thought it was, because this was this side of the business that I was kind of more interested in, to be honest, just because I felt that they had less vulnerability on that. And I also think that some of the food inflation seems to have been mitigated, so we're not going to necessarily expect to see the same amount on that side. So 12% year-on-year anticipated EPS growth. Let's take a quick peek at the chart here, see what we've got going on there. It has softened up a little bit, but you know that multiple is a little bit rich. Are we above the 150? I'm curious. It'd be nice for us to phone a friend and call Carter and say, do we think if it is above the 150, is it going to bounce off of that level? But there we go. Yeah, so kind of a testy level right here, as we can see. But I do feel like if this one holds above that, stay long, you know, be long is kind of my thinking on that. All right, so that was one. Let's pick up another. What do you think on Chipotle? Oh, here we are. Chipotle. Okay, so why don't we just take a look at these really quickly. Now, I had previously spoken about Chipotle, which I mean, it's one of the really phenomenal growth stories, to be sure. Again, you know, I was a little bit concerned about valuation recently, and for that reason had suggested that it was not the place to be. This one, by contrast, does appear to have sort of fallen below. So I guess issuing a cautionary bit on that was, I'm not going to call it prescient. By the way, you know, I want to make the following point. So we're bouncing right off there. Be interesting to see. As you guys know, I do, of course, look at valuation more in terms of the margin of safety. You know, if a stock has momentum, if they're growing the top line, if their margins are steady, you know, stocks grow into their valuations. And I don't think that valuations, by the way, are a very good timing tool. They've never proven to be, not in my experience. And so you're far better off just, you know, picking good businesses and, you know, trying to look at the macro and microeconomic backdrops to see. That said, you know, I will do things like look at the technicals as we have here. And this was one that, you know, I just felt like it was getting into a risky spot, and it looks like it's actually fallen pretty precipitously since I said that. One of you probably can remember, because I'm pretty sure I discussed it on the live stream actually. Let's see how far down that has fallen. 18%, and we're right back to the 150, which is, that can introduce a little bit of anxiety. That's a fairly critical level. Will it bounce? Will it not? So what we're going to do is we're just going to take a look at some of the other technical, that's not overwhelmingly positive, is it? So if you're not familiar, I don't know if you guys can see my screen or not, and if you can, I apologize. There's a lot of information on here. It just looks like the Matrix, I'm sure. What this is 1 year's worth of the most effective technical indicators for Chipotle going back over the last 52 weeks. And of those that were profitable, what we see is, so it looks like there's about 10 indicators that were actually profitable over the course of the last year, and one isn't even a technical indicator that's positive. Every one of the technical indicators that has been effective for trading Chipotle over the last 52 weeks, every single one of them has it as a sell right now. So you combine that with that 150 level, I think that we probably have to sort of stay away from this one still. I'm just going to pull that chart up one more time so everybody can get a good look at it. But yeah, it doesn't seem like this is a really attractive entry point. And like I say, the fundamental story is usually that margin of safety if you can get it, which would be nice. I like to look at it relative to 47 times forward. I mean, obviously they've been growing EPS quite effectively. Yeah, we can see last year was 33.5%. Obviously very strong, decent free cash flow and decent free cash flow growth, it should be said. But right now, these kinds of cases, I would rather miss it bouncing back than try to call it early and try to catch the falling knife. There's no real prizes for trying to be a hero here. I don't think I've ever bottom ticked a stock or top ticked a stock. It's not a game worth playing as far as I'm concerned. So I would probably let this one go a little bit more. What was the other one? I think you had also said Papa John's. So this is interesting because, of course, we've talked about this before. Papa John's had big management shakeup, fairly or unfairly. The founder was looking for the potential to get back involved. This one is considerably cheaper as a result of that turmoil. But it doesn't really have great top line growth. Could it come back though? And my thinking on that is that there is a possibility, and you have a little bit more of a margin of safety. The problem that I have though is that we haven't gotten confirmation either fundamentally or technically that turnaround has started to take place. So while the valuation on a trailing basis looks compelling, the full year revenues for Papa John's is actually forecast to be lower year on year, which is much worse when you inflation adjust it, right? So, to me, I was just saying this to somebody yesterday actually. For me, I think a business is flat if revenues are growing either at the rate of nominal GDP growth or inflation, whichever is higher. So if your revenue growth year on year is either inflation or GDP growth, whichever is higher, you're actually just treading water. You're totally flat. In this case, we're probably looking at a 1.5% year on year revenue sales decline. And so that's, in real terms, that's negative growth. Do I want to pay 18 times earnings? Would I rather pay 28 times for growth or 18 times with negative growth? And I think you guys probably can guess the answer. So in the case of Papa John's, I want to see two things. I want to see at least them treading water. I want to see the top line level off relative to inflation or nominal GDP growth. And I'd like to see it bounce off the bottom. And as you can see, I'm showing a chart right now. Yeah, we're not there yet. But it's a good one. I mean, look, these are the things you should be doing, keeping an eye on it. I think that's a good idea. Okay. CEO of SOFI has been buying shares. Shares could go to 9. Or where do you think the share price could be going? Well, let's take a look here. Well, it looks like we've broken through a couple critical levels. That's helpful. Are we out of that downtrend? Let me extend this a little bit. Draw a couple lines, shall we? Oops, sorry. That's not what I wanted. All right, let's see if I can draw some lines here. So we're going to go like this. And like this. Oops. I hate using a trackpad, and I know you guys hate watching me do it too. Painful. All right, what we got on the horizon here? So, I mean, I'm not sure that that's really the downtrend that I would be looking at there. Let's see what we have here for potential catalyst coming up for this one as well. So we have earnings in 2 weeks exactly. They're participating in any conferences. Nothing too important there. Yeah, I mean, look, I always would prefer to see management buying rather than selling. And, you know, we have a, you know, they are growing their top line, which I think is also a meaningful positive. I have a soft spot for SOFI, partially because, you know, a friend of mine who lives near here, you know, they have a board seat over there. And, you know, he's highly enthusiastic about that business. You know, some of these things have thus far been a little bit unproven, but I will say this much. I definitely prefer SOFI to other, we'll call it sort of fintechy type plays. It's not necessarily a close comp, but like a Robinhood or something like that. Not really a big fan of that business, Robinhood, that is. You know, largely it has to do with just the nature of what their business is. So, you know, that's a really basic kind of an idea. They are a broker. They were not particularly good at the self-directed brokerage business in terms of execution. They just tried to create it as simple as they could, and their whole business model was based on payment for order flow. And that's not to say that other more established and sophisticated participants in the space don't also rely heavily on PFOF. So, you know, whether you're dealing with Schwab or Fido or any of these guys, PFOF is a big part of their business. What I didn't particularly care about in Robinhood's case was that they characterized themselves. You know, the name Robinhood implies that they're out there, you know, doing spectacular things, and the truth is they're getting paid by the brokers. But SOFI, it doesn't look like we're definitively out of that downtrend that I was just talking about, but I generally do like their business because they are growing the top line, and they are forecasted to become profitable this year. So does this mark the turning point? Don't know. The fact that the CEO is buying shares, this is a positive. So, okay. So how can I play SPY put to cover September to November typical volatility? Good point. You know, one of the things I've observed is that the implied volatility for September and October usually is fairly priced. One of the things that happens is, you know, the tail end of the summer you might find, let's just take a look at the term structure really quickly here. So most people think of, because some very well-known market declines have taken place in October, people usually think of that as being, if you asked the average investor, what's the most volatile month, they would probably respond with October, just because crashes have taken place in October. You know, the 1987 crash was in October. And I think the 2008, the Lehman Brothers crash was October. And, you know, we've had a couple other instances. September is actually also a volatile month, it should be said. And so I think, and as I was just pointing out, by the way, take a look at this. I think this is interesting. You can see that the options market's biggest uptick in implied volatility is between, take a look at these dates, just look at that, October 31st and November 15th. Why? the election. So this is the reason why I rather prefer going out in time beyond the election, as I was talking about at the top, or even beyond the inauguration. And bear in mind, this is something that you should think about. If people think there's a big event that's upcoming and they're pricing a lot of volatility into that event, know that even if you aren't planning to play for it, the decay you're going to experience is probably less than what's written on the tin in terms of theta, so the stated decay of the option. Why is that? Because the event variance is going to see to it that if you normally would expect over the course of time that the implied volatility of an option is going to slide down to the front end of the term structure, that is, that the implied volatility is going to drop. If there's an event in there before that event takes place, that isn't exactly what happens. This bump that I'm pointing out here on the screen right now, that bump will become more and more pronounced the closer to that event that you get. And if the implied volatility of an option is rising through the course of time, then what that means is that the anticipated decay of the option between now and then is actually lower. Now, once the event takes place, you're going to get that vol crush that we often talk about. But effectively, you can carry that option up until then at a lower cost than theta would have you believe. So just my 2 cents, if you are thinking about what's going to happen between Labor Day and the election, consider using options that capture the election anyway. You are going to pay more for them. The amount of leverage you're going to get, the gearing on that option is going to be less, but the decay is also going to be less than you might think, because that event variance is going to be baked into the cake for that option for some period of time. So I hope that helps you there. So yeah, again, September to November, typical volatility. It may be typical, it may be slightly less because the market's holding its breath, the big event being earnings. Just bear that in mind. Michael Anthony says, I can see the screen but can't make out the letters and the numbers. Yeah, I apologize. We're going to have to try to figure out how to blow this up a little bit, because a lot of times the screens I look at have a lot of information on them. And I'm really only looking at a small part of it, usually when I'm answering a question or something like that. So we're going to figure out how to zoom. I apologize for that. It's obviously something important to work on. Okay. Can you review the Fastenal trade? Oops. Not like that, I can't. So if I had my Bloomberg keyboard, some of these things would be a little bit quicker. Okay, so here we have, yeah, we got quite a big pop out of this one, and it's well, I mean, the earnings move itself was not so pronounced, but it looks like it has gotten quite a big move just in the last couple of days. So I'm trying to remember, what day was it that we talked about Fastenal? Was that Monday, I think? Was that Monday? I think it was last Monday, so that would have been back here. Yeah, I mean, what we clearly got was, and it's really this week, a little bit of a rally in this space. I mean, let's take a look at some of the other things that are probably similarly impacted. Oops, if I can get that. I mean, what we're really seeing, as this chart will illustrate, is we've just gotten a huge move higher in industrial. Now, this is good news with respect to the economy, because it suggests that investors believe that we could actually see an uptick. Remember that part of what was going on here was that as we looked at things like the employment numbers, and as we looked at SMI data and so on, not particularly positive for this as a space. Manufacturing jobs, which had been forecast to grow modestly, actually dropped. A lot of the employment numbers that we were getting were favorable for healthcare and government jobs, which isn't necessarily great for the broader economy. But it seems like the optimism for the broader economy, for manufacturing and things like that, has gone up. And there are some questions about whether this is advisable and whether it'll actually even happen. But some of the things that Trump has proposed include tariffs on imports. That would be supportive of domestic manufacturing and things like that. So, and I think we've definitely, net of this weekend, the probability, and with the RNC going on, it seems like there has definitely been a pronounced shift in the sentiment towards the U.S. industrial side. And I think that that is a part of it. The truth is, though, that there are some concerns that first of all, you cannot raise that much in terms of revenues with import tariffs. And the second thing is it's inflationary. And I think it's pretty safe to say that the U.S. electorate is quite concerned about inflationary pressures. That said, my thinking on Fastenal was that it was not going to be that great, and that was clearly wrong. Not wrong on earnings, because actually the earnings didn't turn out to be that positive, but it was wrong in terms of the overall sentiment for industrials generally. Industrials, of course, also includes the transports, which was something that we talked about as well. And we can see that that was a benefit for J.B. Hunt, which I think I pointed out was a name that I did like going into earnings. So basically was taking two names in the space, one that I thought would outperform the other. This one did do well, so that trade worked out well. But yeah, the Fastenal trade, and by the way, one other quick point, first loss, best loss is my general view of this. So, I think we framed a somewhat bearish sentiment there, but just something to think about. So as a pairs trade, worked out fine, but the fact is the sentiment shift is real. So definitely think about that. Okay, so Taiwan Semi, Netflix, excellent question. So let's just take a look at Taiwan Semi first. Wow, that almost looks, could it be too good? Hasn't performed phenomenally coming out of earnings recently, so it seems like folks have been a little bit over optimistic. Valuation is reasonable technically. Looks like, is that a little extended? Let's have a peek here. I mean, generally I like the semis, and I will tell you that the one that I've been hoping would come around, I think Taiwan Semi looks all right here. I mean, 23 times. We've got top line, I mean, that does seem reasonable if they can hold to the growth rates that we've been looking at. So I think Taiwan Semi looks all right. Does look like it's come awfully far and fast, but there's been a bit of a pause going into earnings, so Taiwan Semi, I like that one. Netflix, not quite as exuberant, shall we say, borrowing from Greenspan from 1996, his testimony before Congress, if anybody remembers that. Irrational exuberance. Netflix, not quite so much. One of the things I have to say about Netflix is that I felt for the longest time that they were going to begin to feel some pressure from streaming and so on, the streaming wars. I don't really feel that way. Not personally because of our Holly index, our use of, we subscribe to many of the others, the Paramounts, the Disneys, and this and that. The fact is that they're getting their own content. It's good. I feel like some of these others are coming and going. They're kind of the 800-pound gorilla, and it looks like they're sort of still in the fray. So I think Netflix is still okay as well. Oops, I meant to pull up the. Sorry. I'm going to just quickly take a look at the valuations here on a historical basis. So we're at 32 times versus, yeah, I mean, that's a reasonable valuation. 32 times on 49% year-on-year EPS growth. Projected, by the way, looking forward, not backward. But, I mean, they had 60, I'm sure somebody's going to pay attention and say, what are you talking about? They had 32%. Yeah, that's trailing. So growth rate's not expected to stay as strong as it was. But, look, PEG ratio less than 1. And as you guys know, to me, I'm most interested in companies that are growing. Broadcom, I haven't even looked at this, at what their valuation is right now, but Broadcom, yeah, I like that. In the money long calls, though, you didn't specify which ones. I'm curious, why in the money? Let's just take a look here. I'm curious which ones you own. So just in terms of catalysts, we've earnings, so they're going to be reporting relatively late. We're looking at August 30th. Options are relatively cheap going into the print. It looks like lower than 3.9% implied versus a 4.7% average, and 12.3% pop that we got out of the last earnings. In the money options are fine. A lot of people use that as a proxy for stock, but if the reason that you're doing this is the catalyst of earnings, I wonder if you might consider, maybe as I was doing with the SPY options, it doesn't have to be in the money, but because an in the money call option is effectively a long stock with a protective put down below. You could commit a little bit less capital, buy somewhere between a 50 and 30, 30 to 50 delta call option and call it good. Unless you've been carrying this for a long time, or maybe you had stock and you substituted this, you don't want to, take the gains on it right now. That's okay too, but just an observation. By the way, if I didn't send that to everybody, that was the question. Okay. Michael Anthony points out SoFi already had 2 quarters of profits. Yeah, I was actually just talking about the full year. This is supposed to be the first full year of profitability for them. Stephen asks, how can you play Verizon with earnings coming? It's interesting. Probably not a big implied move here. I fooled around a little bit with AT&T a while back. Lived to regret that, in part because of the stock stub that we got. These companies, they just don't seem to be able to really work their way out of some of their legacy. Now, Verizon's, their legacy wireline business and things like that, it's not as bad, I feel like, AT&T. AT&T had particularly problematic legacy wireline businesses in South America, for example, and it just seemed like too many aspects of their business weren't really functioning that well. They, their cash flow was easily sufficient, it would have seemed, to cover their dividends, but these companies carry a heck of a lot of debt. Let's take a look at what the implied move is here. By the way, as a follow-up to that, extemporaneous thinking here, just sort of spur off the cuff kind of thing. It is one of the reasons, though, I do like to play these names over the longer term with long options, because they tend to carry a lot of leverage on the balance sheet. They have a lot of debt. So they're going to be reporting in 6 days. implied move of about 3%, which isn't a whole heck of a lot. And as we can see, just speaking to my earlier point, this is the company's debt to equity. It's basically 50-50, $175 billion worth of net debt, give or take. So as a mechanism to play it, especially if you're making a directional bet, and if you pick up something that also happens to capture the dividend, because that effectively is going to come out of it, because the options don't get the... it's a way to commit a small... So the next X date is... Well, it's not for a little while. We've got October. So you're only going to get less capital deployed if you're going to use something that goes out that far. But let's take a look here. August 2nd, call options, the 41.5. I mean, these things are dirt cheap, right? You could probably pick that up for less than $1 if you wanted to play it from the long side. But it's hard to get super excited. As you can see here, it's really basically been dead money other than the dividend. So okay, a little bit sloppy today, putting this stuff together on the fly here, a laptop and just a computer and just a camera on a tripod. Just got back from the East Coast from that couple-week trip. But for those of you who tuned in, and it looks like a few of you did, I really appreciate it, and sort of my meandering way of thinking, especially when I don't script this a little bit more, like today. But I thank you all very much for tuning in and for sharing your questions. We're going to have another one of these tomorrow, and so I'll try to frame up, sort of an old school complete trade idea for that, and look over some of these as well. I might have to save these. I'm not 100% sure how I do that, but thank you all very much for watching, and I'll see those of you who are interested tomorrow, 4:15 Eastern. Thanks for watching.